Most lottery winners hand the IRS nearly half their jackpot without putting up a fight. But the winners who keep the most money aren't just lucky, they're prepared. These are 12 smart plays that separate winners who build lasting wealth from winners who end up wondering where it all went. Play 12. Don't sign the ticket right away. Signing feels natural, but it can be costly. The moment your signature is on it, the prize is legally yours as an individual, taxed as personal income. Before signing, a lottery attorney can assign the ticket to a trust or LLC instead, so the entity becomes the legal claimant. Your name stays off public records, and you control distribution from day one. Most states give 90 days to a year to claim. Use that window. David Mercer, a warehouse supervisor from Ohio, won $4.2 million in 2019 and signed within hours. His attorney later said waiting just 48 hours would have saved him close to $400,000. He didn't lose that money to bad investments. He lost it to a signature. Play 11. Take the annuity, not the lump sum. Financial media pushes the lump sum, but that ignores a brutal fact. It triggers the full federal tax bill immediately. On a $20 million jackpot, that's roughly $7.4 million gone in year one. The annuity spreads payments over about 29 years, spreading the tax hit too, and it's backed by US Treasury bonds, making it one of the safest financial instruments around. Sandra Kowalski, a retired teacher from Pennsylvania, took the annuity on her $11 million Powerball win in 2017. Her yearly payment kept her in a lower tax bracket, and her attorneys estimate she'll retain nearly $1.4 million more over the life of the annuity than a lump sum would have given her. Play 10. Claim through a trust or LLC to stay anonymous. Winning changes who has access to you, attorneys, relatives, and scammers all follow the public claim record. But if a trust or LLC claims the prize, its name appears publicly instead of yours. The Raymond and Ellen Family Trust claimed a $287 million Powerball jackpot in 2018 with no individual name or press conference ever released. An LLC can also distribute winnings to multiple members at lower individual rates, and a trust keeps assets out of probate. Marcus Reed, a logistics manager from Florida, won $6.8 million in 2021 through an LLC set up in 72 hours. When a former colleague later sued claiming a verbal split agreement, the LLC structure made the case hard to pursue, and it was eventually dropped. Play 9. Move to a no-income tax state before claiming. 9 states charge 0 state income tax, including Florida, Texas, Nevada, and Washington. On a $10 million lump sum, relocating before claiming can save between $500,000 and $1.3 million. California taxes lottery winnings at 13.3%, and states audit residents who relocate right before claiming, so the move has to be genuine and documented. Patricia and Glenn Hartley won $22 million in Illinois in 2016. Already planning a move to Florida, they waited 61 days to establish residency before claiming, saving approximately $2.9 million. Play 8. Gift money strategically using the annual exclusion. Every U.S. citizen can give up to $18,000 per year to any individual tax-free, doubling for a married couple. You can also pay someone's medical bills or tuition directly to the institution with no limit at all. Thomas and Angela Brennan won $8.4 million in Michigan in 2020. In year one, they paid $214,000 toward their kids' tuition, then gifted $36,000 to each child. Over $300,000 moved out of their taxable estate completely legally. Play 7. Front-load charitable giving with a donor-advised fund. This lets you make a large contribution in your highest tax year, take the full deduction immediately, and decide which charities receive it later. Cash contributions can be deducted up to 60% of adjusted gross income. Kevin Strauss, a construction foreman from Arizona, won $14 million in 2019 and contributed $2.5 million in his claim year, saving approximately $925,000 in federal taxes while building a long-term giving plan. Play 6. Use a charitable remainder trust. You transfer part of your winnings into the trust, which pays fixed income for years or for life, with the remainder going to charity afterward. You get a partial deduction immediately, plus ongoing income now. Robert and Claire Nolan won $19 million in New York in 2018 and funded a trust with $4 million, receiving $180,000 annually for 20 years, an immediate deduction of about $1.1 million, and a scholarship fund projected at over $2 million. Play 5. Hire a tax attorney before signing anything. Not an accountant, a tax attorney, whose advice is protected by attorney-client privilege and can't be subpoenaed in an audit. Most winners who skip legal counsel make several irreversible mistakes before they even leave the claims office. Jason Whitfield, a postal worker from Georgia, won $3.1 million in 2020 without hiring an attorney. Within 18 months, he'd received over 300 solicitation letters, lost $180,000 to fraudulent investment pitches, and was sued by a cousin claiming co-ownership of the ticket. A tax attorney typically costs between $5,000 and $25,000, often less than 1% of the winnings. Play 4. Spread deductions across multiple tax years. Your claim year is your worst tax year ever, but charitable deductions that exceed annual limits can be carried forward up to 5 years. Margaret and Louis Fontaine won $72 million in Louisiana in 2017 and structured $3.8 million in charitable giving across their claim year and the following 4 years, saving approximately $1.2 million in federal taxes over that window. Play 3. Set up a family limited partnership. You create a partnership, transfer part of your winnings into it, and give family members limited partnership interests while keeping control as general partner. Because those interests lack marketability and control, they can be valued at a discount of 15 to 35% for gift and estate tax purposes, letting you transfer more wealth while using less of your lifetime exemption. Caroline and Brett Summers won $31 million in the Mega Millions and transferred $12 million into a partnership their attorney set up within 90 days. Thanks to valuation discounts, the taxable gift was assessed at about $8.4 million, preserving $3.6 million of their lifetime exemption for their heirs. Play 2. Invest in opportunity zones. These are designated low-income areas where investors get major capital gains incentives. Investing a portion of your lump sum into a qualified opportunity fund within 180 days lets you defer capital gains taxes, and if held for at least 10 years, any appreciation on the investment itself becomes completely tax-free. Derek and Simone Ashworth won $16 million in Florida in 2021 and invested $3 million in a Tampa real estate opportunity fund. If it grows to $7 million over a decade, that $4 million in gains would owe nothing in capital gains tax. Play 1. Stack every legal structure together. This is the play the wealthiest winners actually use. A revocable trust claims the prize to protect privacy. That trust owns an LLC for day-to-day transactions and liability protection. The LLC partners into a family limited partnership, holding the bulk of assets with valuation discounts. A charitable remainder trust generates income and deductions. A donor-advised fund handles annual giving. And a portion of the lump sum flows into an opportunity fund to defer and eliminate future capital gains. The Caldwell Family Trust claimed a $43 million Powerball jackpot in 2020 with no individual name on any public document. Within 6 months, their legal team had implemented the full stack, projecting lifetime tax savings of over $11 million compared to a standard individual claim. The IRS isn't doing anything wrong by taking 37% off the top. But it's also not stopping you from using every legal tool available to keep more of what you won. The winners who understand that don't just win the lottery, they win what comes after. Every play on this list is legal, documented, and used by real winners today. The only question is whether you'd be ready to use them.